Do you understand that most due diligence is not about finding what's broken? It's actually about finding something that works.
I just had a great conversation with Chris Carsley. Chris has been in the investment industry for more than 25 years. He's currently managing partner of Kirkland Capital Group, a real estate financing company he and his partner started in January of 2020. Chris has extensive experience as a trader, portfolio manager, and analyst at a variety of investment firms. During that time, he developed a reputation for his thorough diligence and deep analysis. So that's what I wanted to focus on with him today, and he delivered. In this interview, he shared some absolute gems from his experience. You get to hear nuggets from his days as managing director of Blue Water Global, where he led investments in a variety of venture capital projects. He also shares great stories and lessons learned from his days managing individual portfolios. Chris is passionate about educating investors, and you'll hear that consistently. Welcome to my conversation with Chris Carsley on investment due diligence.
One of the questions you asked was like, what's the wildest thing you ran into in due diligence process? And as you know, I mean, I've run into just a ton of crazy stuff, like people just blatantly lying about things that are easy to find. But one thing I like to switch about due diligence is most people are doing due diligence to find something that's broken. Do you understand that most due diligence is not about finding what's broken? It's actually about finding something that works. And so I always laugh when someone's like always trying to look for the bad in due diligence. And I'm like, no. Due diligence, if you've kind of prepped yourself right, is more about that next step of finding something that was good that you might want to invest in. And you've got to take that next step of, seeing if the say and the do matches. And that's one thing. It's like everyone, as soon as anyone talks about due diligence, they go negative. Like, I'm looking for the fraud. I'm like, that's fine. But in reality, you should have already set a number of parameters of like, hey, what are my non-negotiables? What am I looking at from an investment? And now I'm down to, by the time I'm about to do due diligence, and I'm about to pull up hundreds of pages of legal documents and everything else, you should be on the hunt for something good, not something bad, And I can give an example. So years ago, I had a partner of mine at a large fund of fund walk into my office, and he goes, I've got the weirdest trade. There's this fund starting up. They're relatively new. And, they're doing this trade. And after we looked at it, we kind of labeled it as like, it's like a legal arbitrage. It's like it exists in the legal system, and there's a way to make money on it as long as you have the right network and all the pieces. So it wasn't like something I'm going long, short something or anything else. It was, you end up doing that, but you had to have so many other pieces in place. And what I'm referencing, if you don't know about it, it's appraisal rights. So, when there's a merger or something of that nature, you can actually run your own appraisal, come up with your own effective valuation. And then, under, basically Delaware law, you can actually file non-publicly and say, hey, I can come out and say, well, I don't agree with the valuation of that merger. This is the effective valuation. And here's my lawyers, and I can go in front of the judge, and I can actually make an appraiser right claim. Well, you can understand if you don't have the network of judges and the legal background to understand all this, and this is why we called it a legal arbitrage. Well, it's very hard to just take your valuation and, who do I go talk to about it? Do I just get up on top of a building and scream as loud as I can, this is an unfair merger price? Well, no. There's a whole process and procedure. And so, it sounded kind of like too good to be true. And after doing just months and months of meetings and work and walking through trade examples, talking to lawyers, reading Delaware law statute of this, I mean, like, what? There's literally like pages about appraisal rights and the whole process and how it actually works and where does your money go and how does it sit? I mean, you have to educate yourself about all that. That's due diligence, is really educating yourself about, wow, we really found something. Is it too good to be true or is it real? And, between the two of us, we were like, this is unbelievable. We've never seen anything like this. We certainly don't have it in the portfolio. So we ended up kind of putting our toe in the water. Obviously started off very small. And as we built familiarity and we worked through, going from that, what I call the ivory tower trade of like, I'm watching from a distance, so it's not real. I don't have real loss in line. We put some money in. It was deployed into a series of trades. And, okay, so now it's real. There's real accounting, real money, real movement, real valuations being done, things coming back from the court, conversations with lawyers and notes. And so we had privy and transparency to all that. And we made some pretty good money on the first couple of trades. And one of them actually, and this can't happen in this trade, it just kind of went nowhere. It's like it didn't happen. The merger failed. And so, okay, but that actually wasn't a big deal. So, because you got to remember, your money's sitting around making like treasury-based returns. When treasuries were paying something, we had a whole period of where they weren't. But you're now looking back at a period of where that money's sitting in cash. That's a value again. I mean, there's actually, you're not, making zero, which made this trade difficult. While you're waiting for the entire merger to happen and have your valuation approved and the court decision and they're honoring your value. And, there's a whole bunch of process I'm not going to go into for this trade, but that was due diligence. And it's really kind of funny to this day now. It's still part of the portfolio. There's a number of people who, this trade's a little bit, older and people know about it. But the guy who brought me the trade to look at, my coworker, he actually runs a fund doing it now. I mean, he's like, he recognized a niche and he's like out running a fund, doing appraisal rights. So, I mean, that's sort of.
Yeah, I was going to say, what do you mean by that?
Yeah,
that's
yeah,
perfect. So he took what you learned.
And
he
learned, yeah. Well,
and now he's running with it.
Yeah, he's running with it and he actually is running a fund doing it and he's doing pretty well. So that's my view is like, well, what do you really want to uncover in due diligence? And every once in a while you will run into the total crazy. But I think it's more important what did that due diligence do? Did you discover something that's in a really inefficient space and you found somebody who has a particular edge in doing it and it's very differentiated from what you own? I think that's really where you want to target your time for due diligence because it is time consuming. It can be costly. And if you're just on the hunt for what's broken, hopefully you found other ways before you get down to the deep dive. You can eliminate things that are broken before then. Because if you're spending all your deep dive trying to find breaks, you're still spending probably too much time. You got to find another way to create a filter that will get you around, somebody comes to you and just says something that just you can't understand it. I mean, this is one of my firm beliefs. If you have someone explain a trade to you, this is what I do, and you still don't understand it, you can ask another question to see if they can explain it in a different way. But you got to make a decision of like, hey, I'm not saying what you do is wrong. It's just, it's above my head. I don't get it. You should just walk away. There's a lot of places to deploy your money. And I mean, there's no lack of opportunities out there. And if someone can't answer your questions, you should walk.
But Chris, you're opening up a whole new side of diligence because most people think of it as the Department of No, right? That you're taking it to the attorneys. They're finding a reason not to do this, and you're saying no. You uncover the gems. You uncover the gold where it is hidden. And if they really have gold, then you run with it, right? And you guys did, and you succeeded in that investment opportunity, right? And then you even exceeded the success that you had.
Well, and it gets down
now going off and doing a new fund with it.
Exactly, and now it gets down to the same issue. Even you're going to go start a fund or you got an investment idea. Do due diligence on yourself. What is your inefficiency? What is your edge? How are you different? If someone's going to do diligence on you, what's going to be that aha moment for them of like, oh, wow, this is something a little off the beaten run. Okay, great. I understand what they're doing and how it's different and how they're going to create a repeatable excess return. I mean, that's my view of, when you're going to do the deep dive due diligence. If you are reading hundreds of legal pages to find no's, you are doing it wrong. I'm sorry, you're doing it wrong. I mean, you should have come to your no a lot sooner. You should back up and rethink about your first 2 or 3 filters of what you're saying yes or no to. I mean, I have a deluge, just a flood of people coming in through LinkedIn constantly, pitching ideas to me. And it's very easy because I'm only looking at a couple things. There's a couple things I do, but I'm not doing any others. And there's a number of things that I invest in, But if you're not targeting what I'm actually looking at and focusing on right now, well, it's really easy. Hey, I'm sorry, not interested. Or, hey, that sounds great.
Yeah, you're talking about like your buy box,
yeah,
right?
it's like I already know what I'm looking for, and I know enough about, like, even if someone says they're doing something, someone just sent me a PPM and I read through it and I was like, there's nothing wrong with that PPM, but there's nothing that was like, wow. I mean, it just didn't grab me. And so I was like, okay, never mind. I mean, it just kind of looked like everybody else's PPM. After you read enough of them, you're kind of like, there was nothing new there. So what's the real inefficiency that I'm going to capture that's going to allow you to, when things get tough, you're still going to do okay? I mean, because let's just be honest. We're coming into time periods right now that things are going to be a little bit more choppy and tough than they are going to be just free, easy walk down the road. So, yeah, okay. I'm not saying those people that have the boring PPM are going to do bad or they're doing anything wrong. I'm not saying it's a fraud. I'm just saying everything looked exactly the same as about 20 other PPMs I'd read. Okay. Not saying yay or nay, but, I got a billion things going on in a day. You got to get my attention quickly as any investor. You got to be able to why you? Why this investment? And if you don't have that, back up and think about, okay, well, how do I create that? I mean, that's that aspect of due diligence. Like you said, it's about finding gold. It's, every once in a while you'll run into the, oh my God, that is ludicrous type situation. But you should have identified that long before you decided to do a deep dive.
Well, I want to come back to what you were saying earlier too, because you're talking about your buy box, right? And I know at Kirkland, you guys really pride yourselves on your diligence process and how selective you are. I mean, tell me a little bit about your funnel too, because you're coming from probably hundreds of deals coming out a year at least.
Yeah, no, I mean, there's a little bit like, okay, that's a different, I mean, that's investment due diligence. Let's shift gears out of like looking at someone else's fund and going through their documents. You're now looking at, for people who don't know what Kirkland Capital Group does, we're the manager of Kirkland Income Fund, which originates, first lien, full recourse mortgages in microbalance commercial real estate. So we're a bridge lender. Yeah, we've got an entire filter that first, I mean, it starts off with our loan broker network. I mean, we have a pretty tight credit box of what we'll look at. So now there's always those brokers that will try to throw anything against the wall. What about that? What about, no, but I mean, the ones that we've been working with for the last, 4 years, they know what's going to stick. You got to understand, they want to get paid too. So it's a matter of like, I want to show them something that has a high probability of getting done, because I don't want to sit here and waste my time on something that may or may not stick, or the terms might change and it won't be, good enough for my time and effort. So that's the first filter, is right off the bat, you got a decent, loan broker network is where we source our loans. That's first. Second, we have some property type filters, like, okay, just not looking at certain types of property. So that's an immediate filter. And then you can get down to, obviously microbalance. It's only a certain size. So, we're doing $200,000 to $1.2 million loans. You'd be amazed how many people come in. Hey, can you lend $5 million against that? Can you? Nope. This is our box. So you have a lot of these really high level filters, and we still receive a lot of loans. I mean, but then it gets into, you got a first initial review. Well, I mean, that's pretty high level. You haven't asked for a lot of due diligence yet. You haven't even done, you're not in the deep dive yet. You're still in the, hey, what's my non-negotiables? I mean, so a lot of what I was talking about earlier and when looking at funds is kind of what we've built in that process at underwriting. It's like, well, exactly. I'm still running through my non-negotiables and trying to understand, like, okay, no. And then you get down to this base level of where, okay, I saw 80 loans, I'm down to 10. Let's go take a look. At least they've made it through. So let's go through and kind of look at the next high level. What do we think? Can we throw them into a risk metrics? And then we, assess, property and borrower. And we kind of walk through and we put together kind of a high level term sheet. That term sheet goes out to the broker and the borrower. Either they accept it or don't. And some people don't. So then you get a filter down from that. And then let's say now you're down to like 3 loans. Well, okay, now it's time to get the thumb screws out. all right, these are all the documents you have to send over. This is all the information you have to provide. But even in that, we've developed a process of what are our high hit no's. I mean, I won't talk about too much of our secret sauce, but even though we request everything, there's probably 2 or 3 things that we do first in a review, because we found if we do those first, it'll get us to a no very quickly. And so we'll walk through those first 2 pieces that we know are the real big hang up, and we can just eliminate right off the bat. And usually you'll have one just right off the bat. Yep, that's not happening. Next. And then you go, and now you're down to 2, and you're like, oh wow, okay, these 2 have passed that next set. And then now you're down to what a lot of people would look at as, sort of the standard underwriting process. You're going through and assessing valuations, and, we use external and internal process to do it. You're walking through the norms. But you can see where you got to have an ability and a mindset to say no quickly. And, just like looking at another fund or looking at a loan or any type of investment, whether you're doing one-off syndications, you might miss out on something. Hey, that was a great trade. You totally missed out. Okay. That's what they call an opportunity loss, not a real loss. And the key thing is to just avoid real losses. There's lots of things to invest in. And yeah, maybe your investment made 10 and those guys made 15. Okay. Live to fight another day. Because,
But the bottom line is, you've got a process, right? And it takes you down to maybe 5%, and that's when you actually start diving in and doing the real hard, deep dive work into things. And that's probably, from my understanding, from our conversations, you've been doing that with every non-publicly traded investment that you've been working with for the past 20 years.
Yeah, and I'll be honest with you. I mean, you can have the best process in the world. Here's the key thing. Due diligence doesn't remove risk. It helps identify what it is. And I think that people have a real big misnomer of do my due diligence, I'm not going to lose money. It lowers the probability. But if you have a return that you can make, you are taking risk. Full stop. There's no way to avoid that equation. And so I've had a lot of people go, we ran into this in even 2008 when we were working with large investment funds. We had people come in and go, I thought you were totally hedged. How the heck did you possibly go down in 2008? And I'm like, do you understand how hedging works? It's like, these were some smart people in charge of billions of dollars. And I was just like, I'm going to try and answer this question as nice as possible, but I think you don't understand how it actually works. And people need to understand, you can due diligence something till you're blue in the face. That is just a probabilistic scale of you having a lower probability of getting into something that, was a fraud or something of that nature, or it will give you the required return you were looking for. It doesn't mean you're going to make the return that was on the documents, and it certainly doesn't mean you're always going to make a return that's positive. You can still have losses. Go talk to a lot of the people in the multifamily world. It was a great trade for a long, long time, and they were just walking along this street doing a little dance, and the world changed very quickly, faster than anyone had ever seen, and people are still dealing with the repercussions of not being ready for that in a variety of ways. I mean, there's just so many things that, were done, and we don't need to dive into a multitude of that. But, those are the kinds of things. And that happens. It's not the first time that's happened. I mean, it's happened across a lot of different strategies. I mean, a lot of different things have, all of a sudden run into some type of global macro liquidity crisis or some idiosyncratic event that really hits that trade really hard. Did the people necessarily do anything underhanded? No. Listen, you just walked right into a wall, and, who put that wall there? Well, it was just thrown up yesterday. You didn't see that? I mean, it was never there before. And that's where, one of the things also you learn is finding those people and developing a system for yourself in due diligence is pay attention to those events, be dynamic about how you're assessing risk. I mean, for us, you know, right now in the lending space, I mean, there's all kinds of different stress and hardships on borrowers and things, and people are going into forbearances, and it's bound to happen in this environment, and it didn't happen for ever and ever and ever, but now it's happening, and I don't think it's unmanageable by any means, but we saw and started talking about it with investors in November. And we started changing our parameters, lower LTVs, looking at certain, property types and saying, yeah, let's cut that, or let's lower the LTV for that, or, hey, we're going to increase the rate we charge on these types of properties. I mean, so you're making all these adjustments, and then, oh, hey, let's, valuation's a big deal. Interest rates are going up, and the private debt world is great because you're capturing that large rate. Well, it's a two-edged sword. There's always a two-edged sword somewhere. And you just got to make sure you don't plant it in your face. It's what most people do in asset liability mismatch type stuff. I'm like, did you not see that one coming? It's, and you can't mitigate all risk. You're going to get caught a little bit. And we've certainly had some loans that we're working out of, in a default situation, which, I mean, that's just the nature of the business. You got to work those out, and we'll get there. But the loans that we're doing now, oh, wow, they're lower LTVs, more stringent valuation than we've ever had, yet we're still charging the same rates. So in certain instances, for people who are looking at, maybe it's private debt or some other investment, you need to be sort of savvy and realize, well, wait a second, am I now accessing this investment at the same level of potential return for less risk? Right now it's kind of happening in the private debt world that's starting to turn that way, but throughout history there's been a multitude of different assets that have taken on that characteristic live, due to some changing regulation or financial crisis or something of that nature. So
sure,
I mean, that's part of due diligence as well. A lot of people forget, I due diligence the hell out of this company and everything else, and it all fell apart 2 years later. Now my first question is, well, what was your ongoing monitoring process? And they're like, ongoing monitoring? What are you talking about? And you're like, okay, you can't. It's just not a shoot once and you're done. You've got to keep an eye on it, and what's the transparency level? What is your process and procedure? Because due diligence doesn't stop. I mean, and I don't care what it could be on a public stock, it could be on a private fund, it could be on a real asset. I mean, you don't. There's, like I always say, it's like there's passive investing. Well, it means you're not on the ground running it. That's about all it means. It doesn't mean you're all of a sudden blind and sitting on a beach, not paying attention to anything, and drinking your Mai Tai. I mean, you need to be aware. You have deployed money. Your job now, as someone who's deploying money to these trades, is that ongoing due diligence. I mean, initial and ongoing. I mean, you need to, keep.
At least you're saving yourself the bombshell later on, right?
Yeah. I mean, and it's like, and sometimes you may find something in ongoing monitoring and you just can't get out. I always laugh, everyone always clamors over liquidity. And alternative investments can obviously be illiquid, and you just need to understand and really work with the manager. Also, it's like, well, when the world falls apart and you think you're going to get your money out, or you want to get your money out, how does it really work? Because that's when everyone wants to get out, and you probably can't get out the way you thought you could at that point and moment. And honestly, you may not want to. I mean, I saw a bunch of people liquidating in 2009, and it was just, you shouldn't have done that. I mean, you should have held on, because if you really believed you had a great asset and it just took an inadvertent hit because of some kind of liquidity crisis and had nothing to do with the actual investment, well, then you were probably going to see a retracement of that value. And a lot of the stuff that we were in, you saw that by the end of 2009, you were flat. So people rode August, September, October, November, December of 2008, finally got a chance to sell in 2009, or mustered the, and they sold, and they created a grinder for themselves. I mean, it was just like you just grinding yourself up, trying to get liquidity. Whereas in a lot of things, if you'd done your due diligence and you really had the time frame and the ability to hold on, within a year, you break even. I mean, in most everything.
Now, okay, you're bringing up '09. This is a great segue into a question I really want to ask you. There are lots of things happening in the world right now. I mean, in '09, we obviously had the housing crisis, how that collapsed.
Yeah.
But we just had COVID, and we're still having the fallout of that. You've got FTX and that whole mess that just happened. AI is now picking up steam, and whether it's the Terminator or the next great thing, we don't know. But it's opening a whole new world for us. There's crypto. There are wars happening right now that weren't happening a year ago. How are you adjusting and thinking things through differently with all these different changes going on?
Zero difference. Here's the thing. I think the only thing that you really added in a big way in due diligence is maybe the focus on technology and cybersecurity. That was not, 10, 15 years ago, that was not a line item in due diligence. It is, and it's a pretty serious line item now. You really want to double check business continuity, all that stuff, hacking, protection of information, employee access to information they don't need, a variety of different things around cybersecurity. That's probably the only change that's been, in my mind, terribly material. You got to understand, all these global macro events that you just mentioned, minus maybe, I'll take this back. AI is the latest technology advancement. There are other technology advancements that could either be helpful or harmful. So let's just throw AI into the tech bucket. This has always been going on. Liquidity crisis, crazy people killing each other. Just all this is always going on. And saying, oh, we got wars. Well, I don't know. Find a time in history where somebody wasn't trying to fight someone else.
Fair point.
Humans have a long way to go before they figure out that, I had a history teacher tell me, he goes, wars are an amazing part of studying history. It's because it's that one point in time where it was deemed by two parties that conversation was no longer possible. So the only way to do that was to kill each other. All right, stop and think about that. That's kind of crazy in a lot of ways. There's always a way to find a new way to have a conversation. But that's a whole nother subject. We don't have enough time for that. But back to the point of where these things have always been happening. It's not anything new. So in most aspects, at least from an institutional standpoint, you're not seeing a big change in due diligence. Process and procedures, other than on the margins of, oh, hey, that's a new changing risk of operational business, or so you're adding that. I think we're at the age of where everyone's walking around with a computer in their pocket 24/7, and we're in this information age to where everything you mentioned and things like that you've mentioned have always been happening. It's just now in your face all the time, so people are more aware of it. And what's really, I think, is really kind of funny. It increases the volatility of things that can be sold. That emotional, behavioral finance aspect of the public market. Things can jump around faster now. Things are going to be more pushed. What was that? You saw Reddit. A bunch of guys just got on and started talking about some stuff. And they made reality. Okay, that was not possible 10 years ago. You couldn't have that. There wasn't that many people glued to an electronic device believing what they read. So it's not that these things haven't been happening. They've always been happening. And as an institutional investor, you were probably privy to that information way beyond the general retail person. Now the retail person can actually get that information, and they can
That's a great point.
They can consume that in the right way or the wrong way. I get tons of phone calls from people. People are always, the last one I had that I really had to stop and think was, well, what are we going to do about the U.S. dollar? Should I get everything out of U.S. dollars? And I'm not going to mention, because if these people watch this webinar, they know I'll talk about them. But, and there was this panic about the U.S. dollar's dead, it's gone. And I just had one statement to them. I was like, countries will naturally always, start to trade each other, and the dollar won't be in the middle in this. And that's been going on for a while. And now all of a sudden it's the top of the news. Okay, you do know that's been going on for a while, and maybe it'll accelerate, or it'll decelerate. I mean, nothing. There's no constant pattern of everyone's moving away from the dollar. The dollar's dead. You know, we're so intertwined and overlapped now economically. You can't just say that. Well, God, what would happen if we, you know, removed an entire country? Well, it doesn't matter what country. It would probably be an impact because everyone's overlapping these days economically. Now, of course, if you removed the largest consumer country in the world, okay, it'd probably be a big deal. You remove the U.S. dollar and the U.S. from an equation of what happens in the world economy. All right, yeah, it's probably a big deal. But so given that said, I just had one comment back to people. I said, okay, so if you're going to get out of something, you're saying I'm going to short that. So what are you long?
Great question.
What's better? So we're shorting the dollar. What are you long? We're getting out of dollars, 100%. Where are we going?
Yep.
And it was really funny when you posed the question that way. Every single person who asked me that question actually didn't have an answer. And I said, well, does that lead you to believe that there's probably no better place right now? 20 years from now, maybe there's a better place. Right now, no better place because there's no currency.
No, that's a great perspective.
So it was just like, so yeah, okay, we hate the dollar, we're going to short it. Great. And so I get those questions every once in a while, and it's funny. And the reason I'm bringing that story up is because 10 years ago, nobody would have had that question because it wouldn't have been on your phone in 15 different ways, screaming in your face of, oh my God, the world's coming to an end. You need to pack up your U.S.
Clicks,
you need to pack up your U.S. dollars and move to some country. I mean, you know, everyone's got to leave. It's all falling apart.
Yeah.
I mean, no, it's not. But we all know that headlines have to be horrific to sell. And there's a lot of that. I mean, we dealt with that in the commercial real estate space. I mean, we had a ton of investors that came in and said, well, is your portfolio over? Are you done? I mean, how much damage are you in? Because I'm reading all this news about how commercial real estate's just done. It's over. Okay, well, one, commercial real estate's not done. Two, is it going through a very hard time? Yes, but here's the key thing. It's the big gateway city commercial real estate, the office spaces. You know, those are the ones that these articles are talking about. They are not talking about some small 20-unit multifamily or mixed-use building in, you know, a secondary or tertiary market. I mean, it's not what they're talking about in these news articles. But I found that when you used the word commercial, many investors weren't able to separate the commercial real estate we do versus the commercial real estate that they're talking about in the article. I mean, two totally different, even though it's the same word. I mean, welcome to the English language. We have so many words that could be used for like 4 or 5 things. I mean, you know, I have a lot of friends that are foreigners and they're always like, man, you use a word and I'm just not really sure what the exact meaning of that particular version of the word was. And I go, yeah, I'll admit, yeah, there's about 4 meanings depending on the context. And that's kind of what was happening. So that yeah,
we English speakers struggle with that anyway, right?
Oh yeah, half time I don't even know. I'm always talking to people like, can you give me a context of what you're talking about? So that would be my answer to that question is like, these things have always been going on, and so really there's no like, oh my God, let's totally advance our due diligence and do things totally different. No, it's. You know, and I understand that maybe for like, you've never done due diligence. I mean, you don't work at a big shop with 20 people doing due diligence on hundreds of different things a month. You know, because it's hard to keep up with, you know, historically. I mean, it was very difficult to get news. I mean, you had a whole procedure of like, okay, we got to go check this and we got to go look at that. And then we got to go to Bloomberg I mean, it was like a whole, like what's going on in the world that's in relation to this trade. You know, it was a process to make sure you kept up with the information, but you had an organization that was doing that. If it's like you and I trying to invest, how would we possibly keep up with everything that's occurring? And here's the problem is the world has found a way for us to do that, but it's not always valuable information that's coming through to our phones and laptops.
Well, it's certainly not efficient yet.
No. Well, and here's the thing is it's now you're worried about like, well, how much of it can be faked and how much of it's a lie.
And the echo chamber.
Yeah. Well, and then AI takes over and it starts, you know, hallucinating and doing everything else. Who knows?
You get the bots coming at you, right?
Who knows? So.
Yeah. So Chris, what if you were to talk to a brand new investor who's jumping into this world right now, just starting at their first alternative investment, private investment, whatever it is? What are the key things that you would tell them to look for in a due diligence process? What would you tell them? Do not forget to.
There's a lot of that. Let me think. Let me back up. I'll think about it. It's like, well, I always say let's start from the beginning. Identify what you're interested and you're passionate about. That's a real key. Go back to your college days when you had to take the course that was super interesting. Well, it was not like going to class and the homework wasn't homework. It was something you enjoyed to do. If you're taking that class that you don't enjoy, it was like, needles under your fingernails. I mean, it's like, oh my, you would do almost anything to procrastinate to the last minute to not do it. And so I would start with that first. Find something that I'm really interested in this. I want to learn this. And it's something that I definitely want to invest in because I think it's valuable for my portfolio, but there's a passion for it. So that's phase one. That one is I'm going to go all the way back and say, develop your non-negotiables. I mean, and I'll admit this. For a lot of people, they're like, what the heck does that mean? And how do I even start down that journey of developing non-negotiables? I totally admit I'm mentioning it as sort of the second step here, and you may not have all of that identified. How you develop non-negotiables, sometimes I'm a martial artist, so I always tell people one of the best learning aspects if you did something right or wrong is, well, you got hit in the face. Well, you clearly did something wrong. So let's identify what you did wrong because you got hit. And sometimes you just got to take that hit. Or you got to go through the pain of going through a series of legal documents to go, wow, after I read through this whole thing, I don't want to do that. I mean, I don't like this fee structure. I don't like this. I don't like the way they do their valuations, whatever it is, whatever red flag you identify. So building non-negotiables can be a process in itself. Next is I found my passion. I've got my non-negotiables. I hear this a ton. Sourcing. Well, where the hell do I find these people or these things? You got to go build a network. You got to, go out to investor groups, talk to you, whatever. I mean, you gotta find, where am I going to find people who've done due diligence on the things that I'm passionate about so I can start my journey and really hopefully start my day of doing due diligence, looking at something that other people have looked at and sort of kind of given a go mark on. But you've got to build that network and source those types of investments. Then, and this is painful, and I'll go back to what I said earlier about building non-negotiables. And I'll tell a little story about the poor credit and legal department at JP Morgan having to deal with me. Go grab something that maybe it came from a source that, hey, I'm invested in, it's like, hey, I've invested in this. Take a look at this PPM. Go read all the documents, literally word for word. I mean, every word. Break it up into paragraphs. Most of these documents are broken into paragraphs. If you've never done this before, and I'm going with your example, this guy's just starting, this person is just in the mode of like, go read one of these all the way through. And every single paragraph, anything you don't understand, make a note. I don't understand what that word means. I don't understand what that phrase means. Anything. And it may look like, a kid grabbed a red pen and went nutso on this PPM, but that's okay. There may be a ton of things in every paragraph you don't understand. You need to walk through that process, because here's the one thing you gotta understand about a lot of these legal documents, regardless of investment type. I don't care, hedge fund, venture, real estate, equity, debt, whatever. There's a massive similarity between all these documents. And the more you read through and answer all those questions you don't know on one document, that's going to answer a ton of questions on the next document you read. That's a fact. I mean, people always ask.
Well said.
People ask, like, how do you go through PPM so fast? Well, I don't really need to read every word because I'm now searching for differences of things I've never seen before. Like, if you write something...
There's a lot of boilerplate,
There's a lot of boilerplate. But you need to be familiar with that boilerplate also. You need to understand what it's saying. Because the last thing you want to do is walk in and go, oh, I didn't know that was going to happen. I mean, trust me, in 08, I literally had people calling... Or actually, 09. I had people calling me like, well, what is this gate thing? What does it mean people can gate? And I'm like, okay, so you didn't understand what a gate was. It's in the document, says they can do it, and now you're pissed because they're not giving your money back and you can't do anything about it because you signed the document. Okay, that's not the fund's problem. That's your problem. You didn't do this exercise and understand what that means. And a lot of documents have the ability to, even mine has, general parameters of liquidity and lockup period and this, and then, hey, I have a whole third clause of where I didn't want a general gate clause. I didn't want to just say, I can gate. I kind of like, hey, we have, even though when things go kind of bad, there's a normal course of business. I mean, like even this year where you've had sort of, lots of stresses on borrowers, we've also had a ton of loans roll off. So we've had money coming back. We've had liquidity, we had, and so it's like not every fund, goes 100% upside down. But the thing is you can run into events where it's like, whoa, wait a second, to protect investors, I need to control liquidity. And it's really funny because there's a lot of people who they kind of look at like, well, oh, you're only going to give partial liquidity. And I always ask them a question. I said, well, I think I'll be able to have some liquidity because of the nature of my portfolio. I could just change that third clause to I can gate. Is that better? Which means I can basically just shut the door and tell you no. Or I can do best efforts of trying to get liquidity as I know that it will happen through the normal course of business. I found a lot of people who haven't been able to compute that process. Like, I don't want to be gated, but I just want to be able to get my money out. And I'm like, okay, the real world doesn't work that way. And any kind of legal document you're going to read is going to have some type of liquidity parameters in them for that oh my God moment of where the world turns upside down and I can't just get money to you randomly, or it will be detrimental to the investors because I'll be selling at a massive discount and everyone's going to lose money because I needed to create liquidity. Any smart document is going to have a clause in there that basically limits that. But, back to our list of, what new investors should do, and not going down the road of too much of like some of the nuances that, people have run into.
You're bringing a great point, though.
It is a good point where it's...
You don't know what you don't know when you haven't done it.
Exactly. But you got to read through. And I'll tell a funny story of like when I was first doing, swap structures. I'm not going to go into what that is. You can Google swap. It was one of the first swaps I'd ever done. And we were creating an S&P collateral swap, with futures. And it was like, I don't know, it was like 180 pages. It was huge. And I went through the entire document and read every single thing and made notes for everything I didn't understand. And I kid you not, I think my notes of what I didn't understand was longer than the document. And so I got on the phone with like the head of the derivatives trading group, credit, and their legal. And it took like 4 working sessions. And I felt, I was kind of, every time I got off the phone.
They didn't have a clue either, did they?
No, they did. And they were like, oh my God, this guy's an idiot. I can't believe we're walking through this entire document by paragraph by paragraph. And it was just like, but for me, it was like, great, I know what a swap is. I know what I'm doing. I know what I want. I know what I want to give away. I know what I want to get. And I know the base parameters because I'm the one that pitched it. But these guys put a huge document together to sort of, this is how it's all going to work. We took everything you wanted and put it into this document. And I was like, whoa, okay. How are you going to get, and there's one thing I've learned about Wall Street. You need to understand exactly what's in all those documents because there's probably about 20 different ways they can get you that you didn't realize. And so we walked through everything. It did. It took like 4 working sessions, and I think he's working.
Not that everybody's bad, but they just want their ways to protect themselves.
No, there was nothing wrong with the document. What I'm saying is I didn't know.
Yeah.
But I'll tell you this. After going through that exercise and going through that document, literally paragraph by paragraph, and having them answer all my questions, how much do you think I knew about swaps after that process? A lot.
Oh, man.
I almost could have been a lawyer. I'm like, I think I'm going to start writing these things. It was just like, that's how it's like, okay, that's what you need to do. And it sounds really arduous, but it's a great exercise for people who are brand new to this. It's a little painful. Break it up into its pieces, but read that entire document. And then once you've done that, go back, do further research, obtain the answers, understand everything in that document that confused you. And then there will be a set of questions. This is what falls out of that process. a set of questions that maybe the document didn't address. Those are the things you take back to the manager and go, hey, here's a series of questions that I came up with that really weren't explained well in the document, or this, or I thought was open risks, or, hey, my network brought up this question and it wasn't in the document. So this was a question people asked, but it wasn't in there. So what's the answer? So, it didn't explain it in the operating agreement or the PPM. And so then you got to take that back to the manager. And this is where sometimes it gets a little interesting, where all of a sudden the manager maybe says something or does something that's like way outside the norm. And now you're in a situation of where, okay, I'm probably not going to invest in that. And unfortunately, I've done a lot of work, but I'm better to walk away or continue to monitor until I feel more comfortable. So that's what falls out of that process. And those are those gem questions. And they're different for every manager, different for every type of an investment. I can't give you examples. It was just kind of like the fallout of that process of, wow, I didn't get the answer to these 5 questions. Let's take it back to the manager and see what they say. And, if you don't like your answer, move on.
Chris, that was a brilliant response to that, by the way. It was perfect. Hit it right on the nose. And on top of that, I think that your picture is probably somewhere up in that department of JP Morgan.
Yeah, they're throwing,
with the beware.
They're throwing darts at it, if that's what it is. They're like, this guy wasting like 5 hours of our life that we'll never get back explaining how swaps work. Yeah. Yeah.
But you invested, right? So
it's all good.
Yeah.
I mean, this was a big swap for you
swapped. You went through the process.
I mean, but it's the same thing. I mean, I use that stories because you're reading through a legal document on how something's going to work, and you got to understand the rules. And if you're willing to write a big check and not understand how it works, okay, it may work out, maybe totally fine, but it might not.
All right, Chris, I got to ask. Final question here. So what is one piece of financial advice you want to make sure your daughter knows?
Oh, yes, my daughter. There's a lot of things I wish my daughter would know. The big one is, and she's actually pretty good about this, so she gets full credit of doing this. She's amazing. She's different than a lot of other kids. Certainly different than I was. She easily parts with certain things, but she's also in this mode of like, I don't buy a lot of stuff. And this applies to everybody. It's like, just don't. There's a lot of stuff to buy. We live in this massive consumer age, and it just becomes clutter. And what was really cool one day is sitting in your garage for like the next 4 years, not being used. And if you think that's going to happen to that, then don't buy it. Find some other way to not do that. Save your money, invest it. I mean, I actually managed money for a few lotto winners, and it's amazing amount of stuff they wanted to buy because it was all of a sudden like, here is an ungodly amount of money. Money, I always say, is a source of power, and if you're not used to controlling power, it will definitely destroy you. And I had 2 lotto winners. One, he actually did really well, listened to what I was saying. The other one did not do as well. She went out and bought a lot of stuff and had some other. She acquired a great deal of friends that she never had that also bought stuff. And unfortunately, the vast amount of her winnings went away. The one thing that was really funny is the one guy that I managed money for, I said, hey, don't buy a lot of stuff. Invest as much as possible. You take a little bit here and there. I mean, you do whatever, but majority of it, invest it. And what you'll do is with the amount of money you've won, you'll find that off the earnings and interest and everything else that we're going to create, you will be able to then buy some things. And you'll find that 2 or 3 years down the road, you'll be generating enough money that you just won't have enough junk that you want to buy for the amount of money you're making on your money. And you'll laugh because the one thing he went and bought, like right off the bat, he worked in high-end car dealership. So he sold Porsches and Ferraris and everything else. And he actually kept working, but he bought himself a Ferrari. And he said, well, the reason I did that, and I'm sitting here talking to him, and he goes, what? And I said, well, it's a pretty expensive car, but I mean, not anywhere near the amount of money you've won. He goes, well, here's the other reason I did it is now not only am I talking about a car to someone who might want to buy a Ferrari, I can now give a real life example because I drive one. And I was like, that's an interesting twist on an excuse to spend $300,000, but okay. And I said, it's your money, but he invested the rest. I managed his money for, I don't know, 6 or 7 years. And it kept on growing. And he laughed about 3 years later. He goes, man, it really played out exactly as you said. I don't have anything to buy. There's nothing left I want. And, and now I'm just making even more money. And so that's sort of my taking that real life example of working with that person who didn't buy all this stuff and invested. It's definitely what I try to teach my daughter of, like, listen, there's no lack of stuff, but you'll be able to afford that stuff later after you've, built a great investment portfolio. So,
Chris, fantastic talking to you today. Thanks for joining me, and I look forward to talking to you next time. Maybe I'll run into you at a conference or something, but I'm looking forward to it.
Yeah, no, love it. Thanks for having me.
All right, take care, Chris.